Welcome, everyone. Let's get right into it, because in today's explainer, we are going to completely decode what is probably the most misunderstood asset class in the entire world, venture capital. I mean, if you've ever wondered how Silicon Valley actually operates behind those closed doors, well, you're in exactly the right place. Today, pulling from some really incredible insider insights, we're exposing a massive structural trap. It's this trap that's just quietly killing the pitches of Central and Eastern European founders, CEE founders, before they even make it to a second meeting. We're stripping away the myths, looking right at the data, and figuring out the true venture mindset.
12. Now, this isn't just some random statistic. This number right here represents 12 agonizing years of total silence. 12 years of waiting, of building and hoping before a venture capitalist might see a single dollar of cash return. You see, co-authors Alex Dang and Ilya Strebulaev took a pretty big risk when they wrote The Venture Mindset to expose this incredibly unglamorous truth. VCs are actually making highly calculated bets on illiquid assets that they absolutely cannot easily sell or trade. So right off the bat, this completely shatters that whole Hollywood myth, right? The idea that VCs are just these fast money cowboys throwing cash around for quick wins. The reality of this asset class is, well, it's entirely different.
Section 1. The cowboy illusion versus the reality.
Okay, let's dive into this. Section 2. The architecture of patience.
An 80% failure rate. Just think about that for a second. In any traditional corporate job, you'd literally be fired immediately for a track record like that. But understanding these structural numbers, that is the absolute key to unlocking the whole venture model. VCs accept this staggering 80% failure rate not as some personal failing or a sign of incompetence. No, they accept it because it's a built-in structural feature of their daily job. It is exactly the math required to find that golden 20% that is eventually going to change the world.
Just follow this journey with me from year 1 all the way to year 12. For years, journalists covering startups have pointed at massive companies, think Spotify or Booking, and they always ask, okay, when is the exit coming? Why is it taking so long? They mistakenly look at a decade-long wait as a delay. But taking 10 or 12 years to finally reach exit visibility and get a cash return, that's not a delay. It's literally the design of the system. That is a full decade of a founder's life and a full decade of a VC's capital deliberately locked together.
Which brings us to this absolutely incredibly powerful quote. Listen, if you're a founder sitting across the table from a Silicon Valley investor, you have to stop framing your need for time and patience as a weakness or some kind of doubt. Don't do it. Instead, use it as proof that you actually understand their architecture. When you walk into a pitch room and boldly say you're building for a 10-year outcome, well, that's not a warning sign to them. It is a massive green light. It's a clear signal that you are playing the exact same game they are playing.
Section 3. Solving unknown unknowns.
And this brilliantly illustrates exactly what we mean. So there's this Slovak investor, Jan Kasparov. He built highly successful traditional businesses: real estate, energy, retail, cars, the whole shebang. He knew exactly how classical business worked. But when he finally crossed over into venture capital, he had this shocking realization. In classical business, you are solving for unknown knowns. You know the market is there, you know exactly who the customer is, and you know the business model. You basically just have to execute and capture your share. But venture capital? Total opposite. You are solving for unknown unknowns. Honestly, sometimes you know absolutely nothing about the market, simply because the product or service you're building might not even exist yet.
Let's clearly define what we actually mean by unknown unknowns here. It's not simply walking into a boardroom and saying, hey, I don't know the answer to your question. No, it is a state where the very category of the question itself doesn't even exist yet. And honestly, this is the single most crucial thing nobody tells you about venture capital. You are not solving for what you already know. You're basically trying to chart a map for a continent that hasn't even been discovered.
Section 4. The pitch room trap.
This deep, massive chasm between traditional, classical business thinking and the true venture mindset is exactly what swallows up so many founders, especially those coming from the CEE region. They walk into a Silicon Valley pitch room honestly believing they need to project absolute certainty. They think every single metric, every answer, every future outcome has to be perfectly locked down. But what are Silicon Valley investors actually evaluating? They're evaluating your relationship with uncertainty. They want to know, can you navigate a market that literally doesn't exist right now? Can you stay standing when your initial plan completely falls apart? And, maybe most importantly, do you have the sheer resilience to pivot when the final product, at the end of this crazy journey, looks absolutely nothing like the product you pitched on day one?
So, I really want to pose this question directly to you right now. Are you pitching the known or the unknown? Seriously, take a second and think deeply about your current pitching strategy. Are you walking in there trying to sell a venture capitalist on a safe, predictable, classical business model? Because if you are, that might be exactly why your pitches are failing to land in Silicon Valley. You're essentially pitching the wrong asset class.
So, the crucial point is how we actually fix this in Section 5, rewiring your pitch. If you actually want to succeed here, you have to fundamentally change your approach before you even think about your next term sheet conversation. We've pulled together the exact actionable steps you can apply literally today. Step 1. Audit your pitch language. Just stop opening your pitch with phrases like, "Oh, we expect to reach profitability by year 3. That is known thinking. Drop it. Step 2. Before your next meeting, you really need to read Alex Dang and Ilya Strebulaev's book, and specifically zoom in on Principle 9 about patience. You have to understand that in VC, patience is structural, it's not just motivational. And step 3, in your very next pitch, find an investor with outside business experience and hit them with Jan's question directly. Ask them, what is the difference between an unknown known and an unknown unknown in how you evaluate us? Let me tell you, their answer is going to instantly reveal if they actually understand the massive vision you're trying to build. Which leaves us with this final, incredibly powerful reframing that I want you to just burn into your memory right now. Silicon Valley funds the unknown. So lead with the uncertainty. Don't try to hide the massive, unanswerable questions of your business. Highlight them. Show them the vast, completely uncharted territory that you are brave enough to navigate. Lead with the problem that doesn't have a clean answer yet, because at the end of the day, that is exactly where the true unicorn value lives. So the next time you step into that pitch room, I want you to ask yourself, are you bold enough to pitch the unknown? Thanks so much for joining me on this explainer, and I'll catch you next time.